Gold and silver have served as currency for millennia across various civilizations. These metals also functioned as stores of value, preserving wealth over time. Ancient artifacts provide evidence of gold and silver's long-standing role in economies. Coinage from ancient civilizations further illustrates their use as currency. The consistent presence of gold and silver highlights their enduring importance in preserving wealth. Cash loses purchasing power due to inflation over time. Gold and silver tend to maintain or increase their value during inflationary periods. This makes gold and silver potential hedges against inflation. Comparative graphs illustrate the historical performance of gold and silver relative to cash during inflation. Holding physical gold and silver reduces counterparty risk. It eliminates reliance on banks or governments. The value of gold and silver is intrinsic. The value is not dependent on the solvency of any institution. Gold and silver possess universal recognition as valuable assets. Their value transcends specific currency systems. They maintain worth irrespective of prevailing economic conditions. This inherent value facilitates their trading in global markets. Their acceptance is independent of geographical or political boundaries. Gold and silver have historically acted as fallback currencies. This occurs particularly during periods of war. They also become important during economic collapse. Gold and silver maintain value when fiat currencies fail. Historical examples demonstrate gold and silver's stability in crises. Gold and silver are limited in supply due to their finite presence in the Earth's crust. This limited availability gives them intrinsic scarcity. The scarcity contributes to long-term demand for these precious metals. Mining and refining processes further constrain the supply of gold and silver. Central banks maintain substantial gold reserves as a component of their overall assets. Gold holdings serve as a hedge against potential economic instability and currency devaluation. These reserves reflect a central bank's confidence in gold's long-term store of value. Gold is often viewed as a safe haven asset during times of economic uncertainty. The level of gold reserves can influence a country's financial stability perception. Statistics on central bank gold reserves are closely monitored by financial markets. Physical gold and silver provide a degree of financial privacy. This privacy stems from the tangible nature of these assets. Unlike digital cash, physical assets are not inherently linked to digital surveillance systems. Bank deposits, conversely, are subject to monitoring and potential restrictions. Gold and silver offer a form of financial independence from centralized control. Secure storage options are crucial for maintaining the safety and privacy of these assets. Portfolio insurance is an investment strategy used to limit potential losses. Gold and silver often exhibit an inverse correlation to stocks and currencies. This inverse relationship makes them effective hedges during economic uncertainty. Investing in gold and silver can provide portfolio diversification, reducing overall risk. Historically, all paper currencies have eventually faced collapse or devaluation. This contrasts with gold and silver, which have preserved their value across centuries. The lifespan of various currencies can be compared on a timeline. This comparison highlights the relative stability of precious metals. Gold and silver have served as stores of value for much longer periods. The timeline visually demonstrates the long-term resilience of gold and silver versus paper currencies. Central banks can increase the money supply through currency printing. Printing more money dilutes the value of existing currency. This dilution leads to inflation, where prices for goods and services rise. Unlike printed currency, commodities like gold and silver have a fixed quantity. The limited supply of gold and silver can help them maintain their value relative to inflated currencies. This timeline compares the long-term value retention of assets. Gold and silver are compared against various fiat currencies. The timeline highlights the consistent performance of precious metals over time. Fiat currencies have historically shown fluctuating or declining value compared to precious metals. Gold and silver are considered safe haven assets during global economic turmoil. Investors seek the security and stability offered by these precious metals in times of crisis. During economic downturns, investors often flock to gold and silver to preserve capital. This increased demand can help stabilize or even increase the value of these assets. The mining and extraction of gold and silver are complex and resource-intensive processes. Significant effort and resources are required to locate and extract these precious metals. The difficulty in extraction contributes to the limited supply of gold and silver. This scarcity is a primary driver of their high economic value. The value is further influenced by their use in jewelry, electronics, and as financial assets. Strategic allocation of gold and silver can balance risk in an investment portfolio. Gold and silver can act as a hedge against market volatility. Consider including gold and silver to protect against economic uncertainty. Diversification with precious metals can mitigate potential losses. Allocate a portion of investments to gold and silver for long-term stability. Future economic scenarios involve various potential technological and financial changes. Gold and silver are likely to maintain their relevance as stores of value. This relevance persists regardless of specific economic shifts. These precious metals serve as a hedge against uncertainty in diverse economic conditions.